Hey everyone, Bill Lethman here for MoneyEvolution.com, and welcome back to another one of our daily live videos where we're broadcasting to you every weekday, Monday through Friday. So this is actually episode number 4. Last week, on episode 2, I think it was, I started to talk with all of you about what I referred to as the 7 core elements of retirement planning, and how each one of these 7 elements is going to play a part in your ultimate retirement goals and some of the things that you want to accomplish in retirement. Things like knowing how much your retirement is going to cost. We talked about that a little bit, identifying your gap, where to save money, what types of accounts are going to be best for your retirement dollars, deciding when to collect Social Security, obviously a big one. We talked a little bit about healthcare costs and how that needs to play in there. The 401k plan for many people is going to be another big aspect of your retirement, and knowing how to unlock the full potential of that 401k plan. As you get closer to your retirement, starting to create that plan for income. And then finally, the last thing we get to after going through each one of those 7 steps is choosing your investments. And unfortunately, many people start with number 7. So what I'm going to do here today in this video is I'm going to be expanding on one of these 7 elements. We're going to be talking about where to save money, and specifically I'm going to be talking about some of the tax implications of where you save money and how that might impact your retirement and the amount of money that you have for your retirement to be able to spend there. So I'm going to clear this whiteboard here and do my best to do that reasonably quick here. And once again, if you're watching this video and you haven't already, go ahead and click the like button on our page at Money Evolution, and that way when we're doing our updates, you'll be sure to get notified on that, and you'll be sure not to miss anything. We're also planning on doing a rebroadcast of these on our YouTube channel as well. I think any day now, I think we're going to hit 200,000 views on our YouTube channel. So if you'd rather watch these videos on YouTube, you can head over there and subscribe to the YouTube channel. And of course, you can always get access to the videos on MoneyEvolution.com. So what I'm going to be talking about here is we're going to be talking about some tax strategies specifically for individuals that might be in the higher tax brackets. So first of all, what is the problem? Well, the problem here that I see is that if you have money that's specifically for your retirement, in other words, you're saving that money so it can provide you with a retirement benefit down the road, but you have that money in a non-retirement account, in other words, a non-tax advantaged account, that's going to present, I think, some potential tax issues for you, and that's what we're going to be talking about here. So what we're going to be talking about are some strategies to potentially move that money over to a tax advantaged account. Things like maybe a Roth IRA account or a traditional IRA or 401k. So we'll be talking about some strategies regarding that. And again, this is not intended to be specific tax advice. We are going to be talking about taxes and everything, but of course you want to clear any strategies that we're talking about here today to make sure that they're relevant for you and they apply to your situation. Run those past your tax professionals, your CPA, or if you have a financial advisor or professional that you're working with, run it by them. And of course, we can act in that capacity for you as well and help you answer questions specifically as we do maybe a financial plan for you. So again, the problem is that we have money over here in non-retirement accounts, and we'd like to try to get this over here. So why is this an issue? Well, first of all, the first issue is that if you have money in a non-retirement account, you have to pay taxes every year on that money. And so because of that, because of the fact that you're paying taxes every year on that account is never going to grow to as big of a balance as an account that you have over here in one of these tax advantage accounts where you don't have to pay taxes on that every year. So obviously having to pay taxes every year on that is going to also affect the potential growth of that account. Again, that account's not going to grow to as large of a balance. Number 3 is that because that balance may not be quite as big in the future, it's also going to affect the potential income that you could possibly generate from that account in retirement. And that's what we're talking about here today. We're talking about ways to potentially help you improve the amount of income that you're going to have for your retirement. And then the fourth thing is it could also because you have to pay taxes on this every year. It's going to be contributing to your taxable balance. It could also cause other adverse effects, like maybe like your Medicare premiums to go up in retirement. And that's a big one. We call that one of our stealth taxes, and I talk about that pretty extensively on some of our other videos here, but Medicare premiums could go up. So let's talk about this a little bit more in detail here. So again, you've got to pay taxes every year on this amount. And for individuals that may be watching this broadcast and may be in one of the higher tax brackets, not only could you have to pay regular income taxes on that money, but you could also get hit with something called the Medicare surtax. And maybe some of you watching this are familiar with that. So the Medicare surtax is going to kick in for people that have an income, if you're single, where your income is over $200,000 a year, you're going to have to pay an additional 3.8% tax on any of your investment income if you're over that level. If you're married filing a joint tax return, that 3.8% is going to kick in at $250,000 of income. So that's part of what we refer to sometimes as the marriage penalty. So a single gets all the way up to $200,000 of income, but you can see as a married couple, just getting over $250,000 a year of income is going to kick them into that bracket where they're going to get hit with an extra 3.8%. Additionally, for any of you watching that may be in the highest tax bracket, the 39.6% tax bracket, and that's for people whose income is over $413,200 if you're single, and $464,850 if you're married. And what happens for individuals that are in that category is the preferential treatment that you get for long-term capital gains and for qualified dividends. That tax rate is going to jump from 15% to 20%. So you can see how this very quickly adds up. If you are being affected by this, meaning that your dividend income and your capital gain, long-term capital gains income is going to be taxed at 20%, you're also going to get hit by this. So now you've gone from a 15% tax on that money to now 23.8% tax. So this presents kind of a real challenge here for, I think, a lot of people watching this. And a lot of people may not necessarily realize that. They may just be earning their income and putting money aside, but they're not really taking into consideration how all of this is going to work in here. So I'm actually going to try to do another little wipe here and clear up a little bit of my whiteboard. Grab the rag I threw on the floor. Okay, so what are some potential solutions? Well, number one is that we want to get money from this non-retirement account, again, to your tax-advantaged accounts. And there's a couple ways we can do that. Number one is if you have a 401k plan at work. Many of you may not necessarily be completely maxing out that 401k plan, but for 2017, if you're under 50, you can contribute $18,000 a year. And if you're 50 years old or older, you can go up to $24,000 a year. So method number one is to get more money into your 401k plan. And a lot of people may not be fully maxing that plan out. And don't forget, if you're married, your spouse may have a 401k plan or retirement plan through their employer that you can max out as well. So that's item number one. Item number two is the Roth IRA. Now, unfortunately, because we're talking about high-income individuals, you're probably thinking, hey, I don't qualify for a Roth IRA account. I make too much money. Well, that may be true, and there is some income restrictions on this. So for 2017, if you're single and you make over $118,000 a year, your ability to contribute to that Roth is going to start to get phased out. And if you make more than $133,000 for the year, you can't contribute to a Roth directly at all. And then for 2017, if you're married and you make over $186,000, your ability to contribute starts to get phased out, and then over $196,000, you can't contribute at all. So how do we get around this? Or is there a way to get around this, I should say? Well, there is one potential strategy. because the IRS lifted the restriction on converting traditional IRA account money to a Roth IRA account, you can now do what I call a kind of a backdoor strategy. You can make a contribution to a traditional IRA account. Get my rag here, I wrote that wrong. So you make your contribution to your traditional IRA account, and then you immediately convert it to your Roth. And again, because there's no income restrictions on making this contribution to your IRA account, and there's no restrictions on income for being able to do a conversion, you could do your regular IRA contribution, $5,500 a year for 2017 if you're under 50, and $6,500 a year if you're 50 years old or older. And again, if you're married and you have a spouse, you can double that. So you can do $11,000 if you're under 50, or $13,000 a year if you're 50 years old or older. Now, the one catch here that you have to be very careful about is if you have other IRA accounts. Doesn't matter where those IRA accounts are at, but if you have other IRA accounts, then this strategy becomes a lot more difficult because you're going to have to use what they call the pro rata rule. So if you have money over here, let's say you have $50,000 or $150,000 in this account, and it's money that hasn't been taxed, you need to consider all of these accounts as one gigantic IRA account when you go to do the conversion. And again, that gets a little more complicated. I'm not going to get into all those details here today, but keep that in mind. So this works very well if you don't have any existing IRA accounts. Number 3 is kind of probably one of my favorite strategies, and it's a strategy using an account that you may have through your employer-sponsored retirement account at work, and it's called the Aftertax account. And so this became very interesting back in 2014 when the IRS made a couple changes to some of the tax rulings on this. And essentially, find some open space here to write. What it allows you to do is if you're under 50, you can contribute up to $54,000 a year to your employer-sponsored retirement accounts. And if you're 50 years old or older, that amount jumps all the way up to $60,000 a year. And how this works, let's run through an example. Let's say that you're 50 years old, so you get the $60,000 contribution. So you can contribute still a maximum of $24,000 to your 401k. And that can be a combination of Roth or traditional, however you want to split that up. Can't go any higher than that. Let's say your employer is giving you a match. We'll make the math easy here. Let's say they're matching $6,000 on those contributions. And so you've got a total of $30,000 so far going into this. That difference, whatever that amount is, in this case it's $30,000, that $30,000 can be put into an after-tax account through your employer-sponsored plan, so you can contribute all the way up to $60,000. Now, what's nice about that is, again, in 2014, the IRS made a tax law change to this, and now they let you take money that is in a after-tax account through an employer-sponsored plan, and now you can roll this money over directly to your Roth account. Try to draw sideways there. So that has huge implications for many people watching this that have that. Now, every 401k plan does not have an after-tax account. Many of them do now, and I think more are adding that in there. But you definitely want to check on that, and if you're not sure or you don't know 100% that you don't have it, make a call to HR, ask them the question, find out if it is something that's available. Now, if it is available, a couple things that you want to keep in mind. Number one, the pro rata rules that normally would restrict us a little bit on these backdoor strategies like we talked about here, that's not going to be a factor here, so you don't have to worry about that. But you do have to make sure that your employer allows for something called an in-service withdrawal. In other words, that this money is eligible to roll out while you're still actively employed by the company. Chances are they probably will, but you want to double check that and make sure that they're going to let you do that. Otherwise, that money may have to sit in there until you retire or you separate service from the company, and that's going to take away some of the advantages of this account. The other factor in here too is even though you might have, according to the IRS, up to $30,000 that you can contribute there, you may be limited by your employer to a certain percentage of your salary. I've seen it basically where maybe 10% of your salary is the maximum that you could put into that. So if you're at a $200,000 salary, you might be limited to only putting $20,000 into that account. You may not be able to go up to that full 30. So that's another factor there. So there's a couple of strategies there that you can use to, again, kind of shift some of this money over to a tax-advantaged account. Another strategy, I'm not going to get into a whole lot of detail here, but annuities and life insurance are another potential tax-advantaged account where you can remove it from an account that you have to pay taxes every year on to an account where you've got some tax advantages. Now, with annuities and life insurance, that gets a lot more complicated. They can be higher cost, and certainly if you're considering that, you want to weigh those potential higher costs along with any of the potential tax savings that you may be getting as a result of that. And then finally, the last thing that I want to talk about here as it relates to this is if you're in a high tax bracket and you've used some of these other strategies, you may still end up with some money over here in this non-retirement account. And that may be okay. There may just be nothing really that you can do about that. But the final step in this whole process is to start paying attention to what kinds of investments you put inside this non-retirement account. Certain types of investments have a little bit different tax characteristics. For example, interest income. That's taxed at your ordinary income tax rate. And if you're in one of these high tax brackets, that could be 39.6%. Plus, you might also get hit with that Medicare surtax of 3.8%. So interest income for non-retirement accounts is a very tax inefficient type of an investment that you could do there. Short-term capital gains is another one too. And those are investments that you buy and then you sell shorter than a 1-year time span. That's also going to be taxed at ordinary income. So a strategy here is to start thinking about as you're putting together your overall asset allocation, maybe you want to do things here that are geared more towards long-term capital gains where you can maybe potentially defer taxes out a couple of years out into the future where you're buying and holding things for longer periods of time, things that have qualified dividends. And then if you want to have some bonds or some things that pay interest income, put those into one of your other more tax-advantaged accounts, and then that's a way to kind of balance that off. So I know I went kind of quick here with this video and gave you hopefully some pretty good ideas. Again, if you're watching this video any place other than our blog at moneyevolution.com, and you want to head over, check out some of the resources that we have there. We do this as part of the 7 core elements. This is something that plays into our comprehensive financial plan that we do for clients. And I'll probably include a link here below this video. And if you click on that link, it'll take you to a page that'll tell you all about our financial plan that we do, where we, again, will address each one of those 7 core elements and see how it affects you, help you make decisions on which of these accounts may be best for you and your family, Roth IRAs, traditional 401ks, kind of look and see how all of that stuff kind of interrelates to one another. So anyway, that's it for this video. If you like what we're doing here, please give us a like, subscribe to our pages, and I'll see everyone back in our next video. Thanks.